Thank you, Matt. Yes, Jedi Options today. The topic is the stock repair strategy. Stock repair strategy. A couple of reasons why this is a good topic. Number one, I know a lot of us have stocks that need some repairing. Okay. They're damaged. They are damaged. Suppose that you are long 100 shares of a stock and maybe you bought it for 90 bucks. Okay. And this was in January. Okay. You starry-eyed investor, and now it's September and the stock market's gotten destroyed. And now your stock is at, let's say, current price. I don't know. Let's say it's 60 bucks. You've lost a third. You're down 33%. Okay. So I'm down 30 bucks. Well, okay, your stock is damaged. Your break even's way up at 90, right? So you need the stock to go up 50%, right? The way the math works, your stock goes down 33%. You need a 50% recovery to get back to even. Well, that may take a while. It might take a while, right? And so you say, wow, what can I do? Is there any lever I can pull, any button I can push to fix this so that I don't have to wait for the stock to go up 50% to make my money, right? So think about your options. Like one, you can just hold on and hope it gets back up to 90, okay? Two, you could say, screw it, I'm out, but I'm going to assume that you don't want to get out, okay? You could double down, right? I mean, think about it. If you buy 100 shares at 90 and 100 shares at 60, your average cost is now 75 bucks. So you can take your break even from 90 to 75, but you got to buy another 100 shares. You know, it's 6,000 bucks cash, 3,000 on margin. And so the challenge there is you're increasing the risk, right? This increases the cost and the risk. But it does lower the average, the cost basis, right? Lowers your break even, increases the probability that you're going to get back to break even because stock doesn't have to go back up as much. And there's a higher probability stock's going to recover to 75 and recover all the way to 90. There's your pro con. Well, listen, is there a door number three? Is there a door number three here? I would like to do something that doesn't increase my cost and doesn't increase my risk, but still reduces my cost basis. It seems like, okay, can I get the advantages of doubling down without the disadvantages? Yeah, in a roundabout way, you can with a stock repair strategy. Okay, stock repair strategy. There's a couple ways to think about this, but basically what you're going to do is you're going to sell a covered call on the 100 shares of stock. And you're going to use that premium to buy an at-the-money bull call spread. Now, you are not going to be able to sell a 1 month covered call and then buy a bull call spread with enough oomph on it to get back to break even or to really move the needle. So what you have to do here is sell like a 3 month covered call or a 6 month covered call or a 1 year covered call. Bring in a whole bunch of premium, use that to buy a bull call spread. There's the no cost. Remember, selling a call against your stock is a free trade. They're not going to increase your cost at all. And then I'm just going to take the premium I receive and use that to finance a bull call spread. And now think about that. What if the stock doesn't recover? The bull call spread expires worthless. You lose what you put into the bull call, but that wasn't your money anyways. You got it from selling the call. So there's like no net. You're not worse off when you do this. You can't be worse off. It's only better off. Okay, it's only better off. There is no worse off when you do a stock repair strategy in the sense that you're losing more. The only worse off is you may wish you didn't buy the bull call. You just straight sold covered calls. Okay, but there's some trade-offs here. So I want to do an example. I want to do an example here. let's say, and by the way, the stock can be down 90%, and I rescue it with a stock repair strategy. You need a magic wand at that point. So the amount of drawdown to be able to execute this, there's some constraints here. Okay, there's some constraints, but let's say I'm going to use Apple. I'm going to use Apple. Let's say that on Apple, I bought it at 183 because I'm a schmuck and I'm unlucky. And I bought it at the high. Okay. So I bought 100 shares at 183. Let's just round it. 183. Okay. Woe is me. It's down to 148. 183. Grab my calculator here. 183 minus current price 148, down 35 bucks divided by 183. I'm down like 20%. This is not nothing. It's not nothing. Down 20% actually feels pretty good if you're in nearly every other stock, but it's not great. It's not great. Well, again, what are my choices here? Let's analyze this trade. If I take a look, here's my trade. And here's my break even all the way up here, 183. I'm down 35 bucks, so 3,500 bucks on 100 shares, right? Okay, what do I want to do? I want to take that red line, that break even. It's so far away, okay? I don't feel like I don't feel like I can get back to it, and if I do, it's going to take me a while. I want to bring that red line closer. Bring that break even closer, baby. Well, listen, one thing you could do is buy another 100 shares, like I said, right? If I analyze the trade again, if I bought another 100 shares at 148, break even 183, just buy another 100 shares, silly. It'll go from 183 down to 165. Boom, you've brought it closer, right? You've taken this break even from 183 and you've pulled it down to whatever I just said, 163. Doesn't seem so far away now, but you had to put in another, $7.5 grand on margin, 15 grand on cash. I'm just like, that's untenable. I don't want to do that. What else can I do? Well, we're gonna sell a covered call, and we're gonna use the proceeds to buy a bull call spread, like a 150, 170 bull call, something like that. Okay, so I got to do a little trial and error here. Okay. Number one, you're going to have to sell a covered call that is lower than your purchase price on the stock because you're not getting any premium up at 183. Forget it. My kind of best practice here is I would probably start looking for a covered call that's maybe halfway between your purchase price and the current price. So call it maybe like 165 or so. Okay. So, all right, if I'm going to sell a 165, I'm telling you it's going to take a little bit of time. So let me start with December, a couple months out. If I sell a December 165 call, I'm going to get, wait, did I say 165? I did. I think that'll work. So 165 call, I could sell that for $3.80. Okay. Say I get 380 on that. And let's just do that piece of the trade. Is that going to fix this? Well, I bring in $3.80, so that lowers my cost basis from 183 to $3 or to 179.20. But the problem is I'm promising to sell the stock at 165. So your basis is 179, and now you're promising to sell it at 165. You're not going to be able to recoup all your loss. So you can't just sell a covered call. You have to also take that call premium and buy an at-the-money bull call spread in the same month, in this case. So I'm now going to go to December, and I'm going to purchase the 150 call, okay? And I'm going to sell a higher strike. Now, I'd love to sell the 165, but that's going to cost me $6. I need to make this trade close to the premium that I received. Can I sell the 160? Then I'm 445. It's good, not great. I need to make it $3.80. So I can already tell you, I don't think I'm going to make this work in December. Okay. But let me just see what it looks like. Let me see what it looks like. So let's right click and analyze. Okay. So what it does is now I can make $600 or so, 550 on this bull call spread. So even though I'm capped at 165 and I can't make all the money back in the stock, I picked up another $550 or so on this bull call spread, but it still doesn't get me back to my break even. So let me push it out a month. Let me go to January. What if I sold a January 165 call? I get $5.35. And then what if I bought a January bull call, but I did a 150? Can I do 162? No, it's not traded. Can I do a 165? It's close. I'm going to have to pay $1 here. But essentially, I'm selling a covered call, and then I'm using the premium to purchase a $15 wide bull call. And now, if we get back up to 165, I'm going to make it all back but $400. Okay. Well, if you continue this exercise, well, maybe I got to sell a February covered call. Okay. I get 690, and then I'm going to buy a February bull call spread for 650. What would it be? Is there a 167.50? Of course not. How about a 170? Close. Let me just go with this. Okay. It's close enough. I bought a bull call spread with the premium I received in the February covered call. And it's made it so that I make enough money on that paid for bull call spread that by the time the stock gets back to about 165, look at the blue line here. Look at my break even. Now it's about 169. I've recouped my loss. I've recouped my loss. Okay. And so I've taken the break even from 183 down to more like, in this case, around 165, 166. I've lowered the break even from here all the way to here without having to pay additional money. Now, I know in this one I had to pay like an extra $100. Okay. Didn't get it perfect. But the point is, didn't really put any new money into the trade. Okay. Added a little bit of options voodoo. By itself, the options component is a 1/2 call ratio spread. I think it's easier to understand, though, if you view it as sell a covered call and then use that to buy an at-the-money bull call. And I've lowered the break-even considerably. What's the catch? The catch is it's going to take some time. You're not going to be able to lower your break-even dramatically and then that be your break-even for tomorrow, okay? February may seem like a long time, but listen, what do you want from me? October, we're pretty much like November, December, January, February. Yeah, 4 months. 4 months. But we cut your break even, by 10, 15%, right? In exchange for you being in this 4-month position. So you can experiment with this. It's a little bit different with each stock, but the principle is you sell the covered call, take the premium, buy an at-the-money bull call spread, start with 1, 2, 3 months, and then you may have to extend it out 4, 5, 6 months. I've seen illustrations where they do this with 1-year options. And usually they're down more than what we're down in Apple. It's like, man, I got to do a 1-year trade. What's the alternative? Aren't you going to stay in the stock anyways? Do you want to lower the break even or not? Right? You can do some pretty fascinating things when you combine sell a long-term call, use the premium, buy an at-the-money bull call, and make the spread with whatever you think you need the spread with to be to get the right cost structure. And then look at the risk graph. And you might discover you really like that new risk graph better than the old one and didn't really require any money, maybe a little bit. But at any rate, that's the stock repair strategy. It's an interesting one. I haven't done it in Jedi Options yet. Had it on my mind today. Thought it'd be a good one.